The dollar reserve system is not going to go gently into the night. The whole military-industrial complex benefits from our ability to create dollars out of thin air and force the countries of the world to transact in our dollars. And they will fight to the death to defend that, whether we want to or not. I think there's more gold in Fort Knox than we know, and that's why it's not being audited.
If the past few years have taught us anything, Ed, it's that so-called conspiracy theories often just need a little more time before they become facts.
This is speculation on my part, but I do think that Jerome Powell at this point is being political. The real economy, underneath the numbers we've seen the last year and a half, has been abysmal. This is the biggest asymmetric trade I've ever seen in my life. This could end up being a ginormous disaster. I suspect 40 to 50% pullback. The housing crisis, which we think, like I said, is a white swan, very predictable, slow-rolling problem that can't be avoided. If you have a $12 trillion real estate market that starts to take on losses, it will be impossible for them to hide the losses. That means run.
But should you? What should you go out and buy then?
This is The Real Story with Michelle Makori.
Hello, I'm Michelle Makori, and welcome to The Real Story, where we go beyond the headlines, beneath the surface, and behind the curtain to uncover what is really happening with money, markets, and power. And the headlines say that the U.S. economy is doing just fine. In fact, Fed Chair Jerome Powell says the economy is in good shape and in a solid position.
Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment.
Now, the Fed has held interest rates steady again and claims that its restrictive policy is not holding back growth. And that positive outlook for growth is being echoed by the IMF, which has just revised its U.S. and global growth forecast upward, citing U.S. resilience. And on the surface, it checks out. Second quarter GDP came in at a solid 3%, a stark rebound from the 0.5% contraction in Q1. Consumer spending is back up. Equity markets are hovering at record levels. The S&P 500 has made new all-time highs at least 12 times this year, the Nasdaq beating that with 15 new record closes. But look under the hood and the picture starts to shift. That 3% GDP number is heavily padded by a 30% collapse in imports. Less imports means less subtraction from GDP, not real growth. Meanwhile, real disposable income is flatlining. Credit card delinquencies are rising. Auto loan defaults just hit a 13-year high. And as for that labor market that Powell says is fine, well, the latest report is showing the cracks, with just 73,000 jobs added in July, well below the 100,000 estimate, and prior months revised down by a staggering 258,000. The employment rate also rising to 4.2%. Which brings us to housing, the linchpin of American wealth, and possibly the next big failure point. According to my next guest, Edward Dowd, we are already in the early stages of a housing-led recession. Dowd argues that the housing market is quietly cracking, affordability is at historic lows, and delinquencies are ticking higher. He calls this the white swan collapse, not a black swan, not some unforeseen shock, but a visible, predictable, slow-motion breakdown that the mainstream is choosing to ignore. Dowd is a former BlackRock portfolio manager and is currently a founding partner of Phinance Technologies, a leading macro research firm. He's known for spotting cracks before they break the system. And Dowd says that crack is housing and that a collapse there will have ripple effects that could hit the credit markets, the equity markets, the banks, and your portfolio. So is housing the first domino in a much larger chain reaction? Is this the final phase of the everything bubble? Could this lead to the banking sector consolidation that Dowd has warned about before, which ultimately ushers in a CBDC? How does gold fit in here? What happens next? And what can you do about it? Let's ask Ed Dowd. Ed, so good to have you with us. Thank you so much for joining us.
An honor to be here with you, Michelle. Thank you.
All right, Ed, I'm really looking forward to unpacking your meticulously well-researched and data-driven report, The Danger of a Deep Worldwide Recession in 2025. We will begin there, but I also want to explore some of your more speculative thinking, especially your theories on why the gold in Fort Knox has not been audited since 1953. Now, some may call that conspiracy driven, but if the past few years have taught us anything, Ed, it's that so-called conspiracy theories often just need a little more time before they become facts. And some of your work on COVID, which has now been pulled into the mainstream conversation, was dismissed as very much conspiracy early on. So we will definitely dig into your contrarian thoughts on Fort Knox, the mystery there, your thoughts on gold, your thoughts on a potential monetary reset, the broader collapse of institutional trust, all of that happening in the second part of this conversation. But let's first start off with your research and your macro view. So give me your 50,000-foot outlook and why you think that the U.S. and the global economies are on the brink of a severe recession.
Well, we have to go back a little bit to a call we made in 2023. We and other economists were predicting a recession at the end of 23, beginning of 24. We have early cycle economic indicators that have been back tested that have been proven to predict recessions quite well. And our call ended up being wrong. And the metrics that we were following did start to rise into 2024, but never got to expansion territory. So we were very perplexed why the recession never came along. So we started to investigate why we were wrong, because we asked the question, have the laws of economic fundamentals changed? And the answer, as we are about to talk about, is no. The recession was delayed, and it was primarily delayed by unprecedented illegal immigration and record deficit crisis level spending in 23 and 24 by the Biden administration. That held up a very fragile stock market. It injected new consumers into the economy that were getting subsidies, and it put a floor on rents. And that delayed the recession, but it also added to the deficit, and it was a sugar high that's not sustainable. President Trump was elected on stopping illegal crossings and deportations. So the flow of illegals has stopped. So the floor under the housing market is starting to ebb away. We're seeing in real time, since we put out our report in January, we're 6 months forward and we're issuing other reports focused on real estate, and all our early leading indicators are rolling over. So we're even more confident now in our call than before. And just to understand, this illegal immigration was the elephant in the room. It's an economic elephant in the room. We brought in officially 12 million border crossings. There have been estimates as high as 20 million, maybe even higher. So let's call it 15 million illegals came into the U.S. in a very short period of time. For you to understand what normal net legal migration is, it's 1 million a year. So this was an unprecedented, very well thought out, very well implemented logistical operation. And the government did give direct money, and also they did wash a lot of the money they gave through NGOs that facilitated this illegal mass immigration.
Yes, and many would argue by design that mass illegal immigration was facilitated in order to change the voting demographics of the country. But again, that's just speculation. But I get your broader point that the U.S. economy's resilience in 2023 and 2024, largely a mirage, fueled by loose immigration enforcement, to put it mildly, aggressive deficit spending, and record savings from COVID stimulus, which you've touched on before. So now you're saying that housing is the canary in the coal mine, that we're headed for a recession, and that the housing market is already cracking. So walk us through your thesis. What data points are you seeing that corroborate this and that others are ignoring at this point?
Well, we're seeing new tenant rents. They started rolling over in the fourth quarter. Very good leading early indicator. It's not very well followed series. We're also seeing, and I'll just read off the chart here we have in front of us, housing units under construction, total units are rolling. Housing units authorized by building permits are rolling. Housing units completed are rolling. And housing units authorized but not started are rolling. These are all very good leading indicators that are predictive of a slowing and potential price degradation in the housing market. So we have low affordability. We have a overbuild, especially multi-tenant housing, which we highlight in one of our reports. And we're going to be issuing a report next week that packages all three of these reports that go into very detailed analysis and show all our graphs and charts work, regression analysis, for those who want to check our work. But again, we made the call in early January based on Trump's policies on immigration. And now we're starting to see the indicators rolling. So we're even more confident that our call is correct and housing market is going to correct. It's not the end of the world. The good news is the consumer is not as leveraged as they were during the 2008 crisis. As prices correct, we expect there to be a rebound on the other side led by the millennials entering the market. But the only variable that can correct this current problem is price. And even if the Fed starts lowering mortgage rates, that'll take time to work its way into the economy, or not mortgage rates, interest rates. They have no control over mortgage rates. It'll take time to work its way into the economy, about 18 months. So a recession is unavoidable. The other problem we have is a stock market bubble, which we had a dot-com bubble that caused a mild recession that then we were taken out of that recession by housing. So now we have the twin problem of the stock market bubble being led mostly by 7 stocks, 40%, 36 to 40% of the S&P 500 is 7 stocks. The market is very narrow. Underneath the market, there's indicators suggesting that all is not well. Small caps have not confirmed this rally. The Dow Jones Industrial has not confirmed this rally since the April lows. So we think we're close to a realization that things are not well. The other problem we had that's been well documented, and Trump is talking about this today, is the non-farm payroll numbers. They were either through gross statistical incompetence and or fraud there were imaginary jobs that were reported in the non-farm payroll establishment report. You got to remember, the non-farm payroll is just an estimate, and then later on, months later, the real numbers are figured out. And the non-farm payroll is supposed to be close to reality. We've seen since the QCEW reports, the quarterly census earnings and wages, which is reality, the actual jobs that were created, there's been about 1 million to 1.5 million difference. So there was definitely something going on under the Biden administration. Trump today just fired the head of the BLS department that is responsible for non-farm payroll. And the economy, the real economy, has been weaker than most suspect for a long time. The problem is, because most people pay attention to the non-farm payroll, the capital markets, the Fed, and corporations have been making malinvestment. They've been investing on bad numbers. So as we start to see the truth come out, this could happen very quickly, the reallocation out of stocks into bonds. So these are interesting times. And I don't see how there's any way the Trump administration can avoid a recession.
Okay, a lot to unpack there. But let's start off with what you mentioned with the non-farm payrolls. And yes, President Trump has fired the commissioner of the Bureau of Labor Statistics. And that's maybe because we just had this very dramatic revision. We see that the report was revised down by a staggering 258,000 jobs. That's the worst 2-month revision since the early days of the COVID crisis. What do you think is going on there? Do you think they're intentionally skewing the data? And I mean, this report came out today. Earlier this week, as we showed, we had Fed Chair Jerome Powell telling us that the labor market is looking solid. I'm assuming he had access to this data. What do you think is the agenda here?
So I'm not in the room at the BLS, but if you've been padding the numbers with gross incompetence and or fraud, maybe what's going on is they've figured out their error and they're getting the numbers right now, and or they've stopped committing fraud. So the truth is coming out. Either way, the real economy underneath the numbers we've seen the last year and a half has been abysmal. And the other thing is there's been a decrease in government jobs. Trump's starting to do that. That was you got to think about what drove employment and the economy in 2023-24. It was illegal immigration and unprecedented government payroll additions. So if you're going to reverse both those indicators that led us to limp along in 23 and 24, as those things that were tailwinds, they're now headwinds. So the numbers are only going to get worse on the employment front, in my humble opinion. And if they're now starting to report the true numbers, a lot of people made bad decisions asset allocation wise in 23 and 24. And Fortune 500 CEOs were making investment decisions based on what they thought was a healthy job market. So this could end up being a ginormous disaster.
Right. And Powell not taking action on interest rate cuts, which, as we know, President Trump has been pushing him to do based on what he said was strengthen the labor market. But I want to touch on.
Let me add something to that. There's a high likelihood that Jerome Powell saw the payroll numbers before they were released in their decisions on Tuesday and Wednesday. So let's assume he did see them. What evidence do we have that he might have seen them? We saw two Fed governors vote no for the first time since 1993. So maybe they saw the numbers and were scratching their heads, why aren't we lowering interest rates? So look, this is speculation on my part, but I do think that Jerome Powell at this point is being political.
I mean, if he did have access to that data, which stands to reason that he would, and then goes out and tells us that the labor market is looking good and doesn't take action on cuts, especially with all this tension and pressure that he's had with President Trump. I mean, yeah, that's not a very inspiring look for the head of the Federal Reserve and his agendas there. But again, speculation.
Also, other news. I forgot to mention this to you in the pre-game. A Federal Reserve governor just resigned as well. Announced it today. Did not give a reason, but she's gone. So there's something going on.
Was that I believe it was Michelle that was one of the dissenting governors that resigned today?
I don't know, but let's just say there seems to be turmoil at the Fed.
Yes. Well, the Fed, the Federal Reserve, is a whole topic for a whole other conversation and a whole other interview, and why we even have the Fed in the first place. But let's work under the premise that they're here for a while, and let's take it back to some of the points that you made about what we're seeing in the economy. And I get your point that, illegal immigration was a big factor here. I just want to challenge that a little bit because, okay, granted, we had about 12 million people coming in, maybe less, maybe more, hard to get that exactly verified. The Trump administration has done a very solid job of closing off the borders, and they're trying to deport people as well. But you still have those 12 million people here. I mean, at the most, I believe that the Trump administration has deported 140,000 people. Some say that number is actually less than that. If these people were a factor in demand and a factor in boosting rents, they're still largely here. So how does that skew the housing market?
Everything is on the margin. And Carlos and I talked about this when we wrote our report. We said, if he's not successful in deportations, will that throw our thesis off? And he came to the conclusion, no, it's about the flow. And the flow was what was keeping up the economy. The flow has stopped. And we have indications that that's already affecting the housing market, as evidenced by our new tenant rent reports, which they started to drop in the fourth quarter, and they continue to drop. And we just had the last new tenant report released. It's a quarterly series, and it's subject to massive revisions. It massively went down. We expect it to be revised up, but the total trend is down to the right. And so we're very confident that just the stopping of the illegals at the border is enough to get this going the wrong way. You got to remember, there's been a lot of speculation in building. We've done really good work on multi-tenant housing, five unit plus structures. We, as a total economy, overbuilt multi-tenant housing construction, the greatest amount of building we've seen since the 1970s, when the boomers were getting jobs and renting before they started to go buy single-family homes. So this is going to affect single-family homes as well. We have new homes inventories at record highs back to 2008 levels. And the biggest problem is, even though people claim, hey, Ed, the market is undersupplied, well, if no one's buying, that's a problem. So one of the charts I gave to you showed homes for sale and homes sold. There's never been a greater disconnect. And if you look at the chart historically, they kind of track each other pretty nicely. So what's the problem? The problem is the affordability is so bad that no one's buying until one thing corrects. And what's that one thing that can correct? Is price.
Well, which kind of links us back to the Fed that I want to touch on. And to your point, look, inventory is building. Buyers aren't buying. Listings up are 31%, according to Realtor.com. Home affordability is at its worst in recorded history. The median U.S. household now needs to spend over 44% of income on housing. Now, you have said that it's not a matter of, there seems to be a clash in the narrative of whether it's a matter of demand or a matter of supply. Now, Fed Chair Jerome Powell would have us believe, as is the sort of popular wisdom, that there isn't enough housing out there. He did acknowledge in his report that the housing sector is the one that does have a bit of weakness. He did say that there was weakness in the housing market, but he also mentioned that the Fed can't really do too much about it, and that it's mostly a question of there not being enough homes and there's a supply crunch. We'll quickly play that soundbite and get your thoughts on that.
Activity in the housing sector remains weak. So the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, but then that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing.
All right, so I mean, firstly, I want to touch on this idea of whether housing undersupply is true or not. Like, the dominant mainstream narrative is that housing inventory remains historically tight. The National Association of Realtors reporting that there's a 4.7-month supply of existing homes as of June of 2025, and that's well below these 5 to 6 months that's traditionally seen in a balanced market. Total housing inventory standing at 1.53 million units in June, down slightly from a dramatically below the long-term U.S. average of 2.2 million. So they're saying 1.5 million units versus 2.2 million units. For context, it was a peak of 4 million homes available back in 2007. So, you have this narrative where you've got the NAR's chief economist saying that multiple years of undersupply are driving record home prices. You're saying that that's not in line with your data.
Well, let's look at what price is doing. Price is stagnated, and now it's starting to roll over, and more listings are coming on. So home affordability is the key. And that's why we're not calling for a systemic crisis as this unfolds, because as prices adjust, there'll be more affordability, and there is supply of people who want to buy homes. And so the market should have a boom on the other side. But if Jerome Powell is right, prices should be continuing to rise. That's assuming that consumers have income and affordability, which they don't. And like I said, the non-farm payroll number has been abysmal. The real non-farm payroll number has been abysmal for the better part of a year and a half. So there's a disconnect. And the disconnect is, sure, there may be an undersupply of housing for those willing to buy, but they can't buy. So price is the only thing that can adjust this. The other thing people need to understand, there isn't just a cost in housing, there's a rising cost in healthcare. So consumers are stretched so thin. Healthcare is going up, auto insurance is going up, and home prices are stagnating. And we think that will lead us into a slow growth, negative GDP economy. And the cycle needs a cleansing, and this will be good. This is not a bad thing. And we have overbuilt multi-tenant housing. We have new home supply. And if you look at the home builder stocks, they peaked last year. They're not participating in this Trump tariff rally. They look very weak to us, and they tend to be predictive of housing recessions. We're close to them predicting that we're going to see a nice recession. We're almost there.
Right. And look, recession, natural part of the economic cycle. So you're saying the housing market's already cracking. Affordability is at record lows, as we know. Mortgage delinquencies are rising. Debt servicing costs are high. Talk me through how this, plays out, how this sort of market, this housing market collapse happens, how it starts to impact other parts of the economy, how it impacts the equity markets, how it impacts the credit markets. What kind of market correction do you expect? Does this trigger a broader financial unraveling? Talk me through your whole scenario here.
Well, so here's the math. 20% of U.S. GDP is housing and housing-related services. That is a big part of our economy. If that slows and goes into negative growth, which we suspect it will, it'll have knock-on effects in the rest of the economy. We already have a PMI below 50, so manufacturing isn't doing well globally. So we have a glut of capacity. There's a problem, and so this will have knock-on effects. And you got to remember, construction is starting to roll over. So as no new permits are issued and no new projects are begun, the construction industry will start to have layoffs, and that'll affect consumer spending. And there's what we call feedback loops. And the consumption is 80% of the economy. And it's very important, and housing is the linchpin of the U.S. economy. Unfortunately, we don't have a ton of manufacturing going on like we used to. So housing is really it. And that is going to cause feedback loops across all sorts of industries. Additionally, as the bond market starts to figure out that U.S. GDP is slowing, bond yields will go lower, and asset allocators will start to sell equities and buy bonds in anticipation of the Fed lowering interest rates. So we also unfortunately have a record stock bubble. We haven't seen these valuations since the dot-com. And if you look at 10-year forward returns on equities at these valuations, they are zero. Meaning, if you buy today the stock market, the S&P 500, and you hold it for 10 years, including dividends, you're likely going to get back to break even in 10 years. That implies a big drawdown between now and then. And so, unfortunately, the Trump administration is going to face a housing recession and likely a stock market bubble bursting. So he's going to have a dot-com recession and a 2008 housing problem. But we don't think it goes systemic. I know it sounds super scary, but the Fed has more tools in their toolbox than they used to. And as I said earlier, the good news is the millennials are willing to buy once prices adjust. I think we can avoid a systemic issue, but if one starts to appear, we'll call it in real time, and then we have real problems.
Okay, how big of a market pullback do you see here? Let's start with that. When you say we're dot-com bubble, like what?
Yeah, given these valuations, the dot-com bubble, we had a 50% pullback over a 2-year period. And during the great financial crisis, we had a 50% pullback. That was driven by an over-levered system, so there was a giant margin call. So I suspect we can just run-of-the-mill 40 to 50% pullback, and it's not the end of the world. And it's great, because if you have money on the sidelines, you can invest at really good prices. And that's what Warren Buffett's been doing for 2 years. I think he also thought a recession was coming in 23, 24, because he's been on the sidelines for the better part of 2 years, accumulating more and more cash. He owns 5.5% of the T-bill market. Berkshire Hathaway owns 5.5%. I just want to reiterate that, 5.5% of the T-bill market. So he's waiting for a nice correction and to scoop up bargains like he did during the great financial crisis.
So potentially a 50% pullback from where? From where we are now? From highs? Do you still think the market?
Yeah, so people were asking me today, the market's sold off hard the last 2 days. People are asking me, is this the top? And I said, I don't know yet, because we need more technical structure to determine whether the bubble has popped. We could have there's two routes. We could have a pullback of 7 to 10%, in the next week or two. Then we put in a low, then we rally, and the rally goes to new all-time highs, slight new all-time highs, and then eventually gives up the ghost. Or the rally fails, and then the bear market is beginning. So we don't know yet. We need more time. But I did say in my post today, given our view on the housing crisis coming, it's sooner rather than later that the bubble's going to burst, and it's only a matter of time when the indices give up the ghost.
And you see this playing out over what period of time? You mentioned the dot-com bubble took 2 years to unravel. Do you see this as being more sudden, more slow?
Well, that's hard. That's really hard to call. But Carlos and I would rather see a 2-year decline, because it means we're not going systemic. If we see a crash, then we probably have systemic issues. So if we get a 40% pullback in a month or two, then we'll start looking at the systemic issues that are potentially there. But again, it's hard to call. It's one or the other. We'd rather see the slow 2-year decline, but who knows? I mean, unfortunately, we have a lot of leverage in the system, and there's a lot globally. There's a lot of problems as well. There seems to be a global real estate problem. We talked about that in our January report. Real home prices had started declining versus inflation about 1.5 years ago globally, and now we're starting to see nominal price declines. That's starting to happen in Japan and the UK. So this could be a coordinated global real estate problem, but we don't know yet. We'll see.
But then again, how does this play out? Is this because banks are sitting on losses? Is it because people, I see how it impacts like the manufacturing side, a little bit of the economy, but how does this really unravel?
Well, if it's a systemic problem, it'll be because banks are starting to admit losses. Then they shut down issuing credit, and that further exacerbates the problem. The lifeblood of our economy is credit creation. So when the banks rein in credit creation, that creates a liquidity problem, and it becomes a self-fulfilling prophecy. So, we might get to a little bit of a scare like that, and if the Fed can act in time, we might be able to avoid it, and I think we will. But this thing the knock-on daisy chain effects could start to really accelerate. And, look, the banks are sitting on $3 trillion in commercial real estate loans that they've been extending and pretending. The Federal Reserve highlighted this in a report in November of last year. The Federal Reserve New York put out a report saying banks are basically lying. They're extending and pretending and not taking losses. If you have a $12 trillion real estate market that starts to take on losses, it will be impossible for them to hide the losses. So this, I suspect, is just too big of a problem for the banks to continue to pretend everything's fine, and it's not fine.
Well, I definitely want to hit on the banking sector and your outlook there, but you're saying that if the Fed starts to aggressively cut rates, then it could potentially, well, not thwart this, but blunt this. I mean, too late Powell, as Trump likes to call him. But even if the Fed starts to cut rates aggressively, I mean, then or inject more liquidity into the markets, and ultimately what we're just kicking the can down the road here, right? And you're just continuing to devalue the dollar ultimately. I mean, that creates a whole other problem.
Right. There will be a correction. We can't save, the risk off trade completely, but they can ameliorate some of the losses if they act quick enough and do unprecedented things. What they're going to do is create inflation on the other side. So again, we don't know what the Fed response is going to be, and we don't know what the fiscal response is going to be. But typically, in the dot-com bubble and in the great financial crisis, people may not realize this. The Fed was aggressively lowering during both, and the stock market losses were unavoidable. So we'll see what happens. Could they make it a 30% loss instead? We'll call that in real time. But historically speaking, once the Fed starts aggressively easing into an economic slowdown, it takes 18 months for that to actually turn into real economic activity. So we suspect if we see the Fed cut 100 basis points in a month or two, that doesn't mean go out and buy equities. That means run, because that means things are worse.
What should you go out and buy then?
Well, you should have cash in your portfolio. Just, look, we're not giving investment advice unless you're a client that's paying us.
But cash in your portfolio, you don't want to hold cash if it's devaluing at the rate that it is, right?
Well, if the stock market's going to go down 50% and your cash is going to be devaluing it a couple percent a year, that's why Warren Buffett's holding 4.5% T-bill notes. He's getting 4.3% to wait. So that's when you get the cash is always good when there's a sell-off like this. So, you don't want to always be in an income-producing asset. And right now, rates are at 4.5%. You're getting paid to sit and wait.
Do you currently have any equity exposure?
No.
So how are you positioning yourself? Not giving financial advice to others, but what's in your portfolio currently?
Cash and gold, just waiting like Warren Buffett.
Cash and gold, physical gold?
Yep.
All right, we definitely want to get your outlook on gold. I know you have a forecast, I believe, for 10,000 gold.
Yeah, 10,000 by 2030. Long-term gold is going to be a part of whatever monetary reset is coming. How do we know that? The banks and the central banks have told us that in Basel III, which just got implemented in July in the U.S. Gold is now considered Tier 1 capital, physical gold. It used to be Tier 3 capital. So that's all you need to know. They can now create loans against it and use it as collateral to shore up their balance sheets. So let's be honest. Gold is going to be part of whatever's coming, because all the other countries of the globe, if there is a new monetary system that's agreed upon, it's going to have to include gold in it again, primarily because no one trusts any world reserve currency to not debase their currency over time.
Okay, that is definitely a conversation that we need to unpack there. But before we do, I definitely want to circle back to that. But before we do, Ed, I want to touch on what you think is going to happen to the banking sector here, because that's an interesting conversation, which of course would lead us back to gold anyway. And in previous times that we've spoken, you expected a banking collapse and potential consolidation. If this housing, collapse plays out and has a bad impact on the financial system. I know you're saying you don't see it as systemic at the moment, but back in 2023, after the collapse of Silicon Valley Bank, that was the second largest bank failure in U.S. history, you said that the U.S. banking system was headed for a controlled demolition, a deliberate takedown, and you said that we would be down to just 6 major banks by the end of 2025. Now, granted, the Fed surprised us with the Bank Term Funding Program, BTFP, which was an unknown there. But do you still see banking sector consolidation?
Eventually. So the Fed did save and put off what was going to potentially be a deposit run on banks, because at the time there was disintermediation. They had portfolios that were underwater and they're held in maturity accounts, and money market funds were paying much higher than deposits. So people were slowly withdrawing deposits and putting them in money market funds, and that was going to cause a run on deposits. So the good news is the Fed came in and stopped that and made a bank term funding program available to the banks and stopped that deposit run. What it did do is it did delay what I think is eventual banking consolidation, that it will probably come in this next recession. Because what the Fed's not going to do, we're going into the credit cycle of the economy, where bad credit's showing up. It's already there: commercial real estate, other issues, and then eventually housing, and then some business loans will sour as we go into a recession. So the bank stocks should come under pressure in our forecast, and then there'll be some that get into trouble. There'll be some shotgun marriages, and eventually there'll be fewer banks in the country. So we're hitting the credit part of the cycle, and the Fed is not going to bail that out. The Fed is not going to make loans on bad credit to the banks to save them this time. And I think they'll force shotgun marriages, much like we saw during the great financial crisis. And there'll be a lower number of banks. And I said, if that happens, it'll be much easier to implement a CBDC. And
right.
That's something that I worry about. I know you worry about that. I don't like people knowing what I'm doing and being able to switch off my money or tell me, what you can do with the CBDC is just incredible. You could, if they wanted to, it's centralized banking policy. If they wanted to increase the velocity of money, they could say, hey, all you people with $10,000 in your checking account, we're going to force you to spend it in the next month or it disappears. They could do crazy things like that.
Look, anybody that knows my work knows I'm very passionate about CBDC, central bank digital currencies. So now, and we'll get more into that, but just to recap, you're saying that you think this recession, this coming one that you're predicting, led by the housing market, will see banking consolidation because you do not think the Fed is going to step in this time. So you do still hold that.
Yeah, they're not going to step in and save bad credit. What they did save last time was duration risk. That meant that I guess they kind of felt bad for the banks because they raised interest rates from 0 to 5.5% in the most insane rate increase percentage-wise we've ever seen. So they kind of forced banks underwater in their held-to-maturity accounts, and a lot of those held-to-maturity accounts were holding, U.S. government bonds and whatnot. So they were able to justify in their heads why they were going to do that. What they're not going to be able to justify is banks with bad credit, meaning they made a loan and at par, and it's now worth 60 cents on the dollar because of economic bad credit cycle problems. They're not going to loan against that, we don't think. If they did, then we're living in a communist, centralized, planned economy.
Well, that may very well be the case. By the way, regarding the Fed, it's Fed Governor Kugler who's resigning, giving Trump a nominee on the committee. That's the person you were referencing earlier. It's Kugler who is now saying she is resigning. She did not give a reason for her decision to leave, just as a side note there. But let's take it back to this banking sector consolidation. As we've said, that's a very bad idea because free markets need competition. They need competition from the banks. And more importantly, this could pave the way to usher in a CBDC, a central bank digital currency. Less banks, easier way to control. You're saying that this could happen as part of this next recession that you're predicting starts to kick in by what? The last quarter of this year, we'll start to see signs of this?
Well, Carlos,
it's already happening.
Talking about, yeah, we think we were saying we start to see it in September. Today's non-farm payroll number may have kicked it off, but again, nothing goes down in a straight line. It'll take a while before things really get wild, but we're predicting September, October, November. It's going to get very interesting. We expect volatility to kick back in. It's been a very low volatile summer as measured by the VIX index, volatility index, and as volatility rises, asset prices tend to have issues. So we think that's going to start, manifesting very soon.
All right, so let's bring it back to the CBDC then, right? Central bank digital currencies, which will be easier to usher in when we've got an economy in distress and banking sector consolidation. Now, as a reminder to our viewers, you touched on this as well, but essentially they are government-issued digital dollars, programmable, traceable, centrally controlled, and that's the real concern. The real concern there is control because they could let the government track your spending, every single transaction, limit how or where you use your money, what transactions you're allowed to make or not make, as you said, potentially allow your currency to expire if not used within a certain amount of time. And then, of course, there's the concern that it gets linked to a social credit score and digital IDs, and then we're dealing with ultimate control, Orwellian style, that the government says, for example, we don't like that. Say we go back to this carbon emission narrative that, although the ESG narrative has sort of subsided a little bit lately, but if we go back to that, the government can say, look, you're spending too much money on flights, you've exceeded your carbon output, you've had too much steak for the year, you've exceeded your carbon output there, your carbon footprint, and your money doesn't work to issue certain transactions. That's just one example of how a central bank digital currency could be super problematic and super terrifying and dystopian, really. What we do have now, though, is we do have the Senate expected to vote on an anti-CBDC bill that bans the Federal Reserve from creating one. Now, that bill is still in progress. The language there may change essentially, but the Senate is looking at it. It was passed by the House, and it's designed to ban the Federal Reserve from issuing, testing, or implementing a central bank digital currency directly or indirectly, to block it from using a CBDC in monetary policy, to your point. And this is about a retail CBDC. Now, you've expressed your concern about a CBDC. This bill is in the Senate, but at the same time, while that's waiting, we did have the Genius Act pass. And some people are saying that that could be a stealth gateway to a CBDC-style financial system through stable coins, because the Genius Act creates the first legal framework for stable coins, and those are digital tokens pegged one-to-one to the US dollar. They're fully backed by high-quality liquid reserves like cash and short-term treasuries. There are only approved issuers can issue them, like US banks, credit unions, OCC-regulated financial firms. They can offer those tokens to the public. And now to qualify, they do need to hold 100% of reserves. They have to guarantee par value redemption, and they're supposed to comply with AML, KYC, and OFAC rules. So know your customer, anti-money laundering, and OFAC rules. And then they submit this to federal oversight. Now, the law does keep the Federal Reserve out of direct issuance, right? But what it does do, according to critics, is it does lay the foundation for programmable money, surveillance-friendly digital infrastructure, and a multi-trillion-dollar ecosystem of narrow money, of digital cash that does not circulate through traditional credit creation, and practically lays the groundwork there. What are your thoughts on that? Do you think that the Genius Act stablecoins could be some kind of gateway to the CBDC? Do you think there's any merit in that argument?
Absolutely. Look, the banking system, especially the big systemic banks, are basically in bed with the government. They fund a lot of the U.S. debt, and they might come in a very dystopian future, we have a president who wants to have more control, and his administration could start to, just like we saw during the 2020 COVID period, the Biden administration surveilling social media dissidents against COVID. They could do the same thing in the banking system through stable coins and force these institutions to give them the data so they could target people if they wanted to. I think it's a disaster.
Yeah, I think it's a disaster. Does this anti-CBDC surveillance bill give you any kind of comfort? It hasn't passed yet, but it is being discussed.
Well, it would be anti-Fed CBDC, but if you're going to have a backdoor stable coin issued by banks that is, behind the scenes controlled by the government, or these institutions have pressure put on them, it's a problem. Look, we now know from the COVID history that censorship was directed by the government via private corporations. And a lot of these private corporations, and Mark Zuckerberg even said the pressure put on him to censor people was intense. I'm not giving him an out. He should have held his ground. But this is the kind of thing that happens behind closed doors. And once you have access to data and the ability to control transactions, it's rife for abuse and ill will, in my humble opinion. I'm a freedom-loving, cash-carrying guy.
I'm with you there, Ed. I'm very much, I believe cash is king. I like to spend cash. I like to keep my transactions anonymous. Not that I'm doing anything nefarious necessarily, but it's part of my libertarian outlook on life. And a CBDC, nothing terrifies me more than that. But a lot of people then say that gold is a way to counter the threat of a CBDC, physical gold, that it could, if we do come to a system like that, that may be a way to opt out of it. What are your thoughts there?
Well, it should be part of everyone's portfolio. It should, again, it's physical gold will be hard to transact in if there's a crisis, but it's nice to have. Gold coins are easier to transact than gold bars. I mean, you can own a lot of gold, but then how do you turn it into money? I think, but long term, as an asset, it's going to appreciate as long as there's a system in place that has survived and we're not in, Mad Max land. Long term, it's going to 10,000. It's a hedge against what we know now is going to be a race to the bottom. These trade wars are the beginning of currency debasement, because a lot of these countries will agree to these deals, and then the trick is you debase your currency to offset the tariffs. And as we start seeing debasement globally, gold will only go higher over time.
Okay, well, before we go to the trade wars, let's talk about what you touched on. You said that you do see gold as some part of a global monetary reset. You did point out that central banks are buying gold at record levels. So talk me through that. I mean, I understand you're not seeing this in any immediate term, or maybe you are, but how do you see gold fitting into some global monetary reset?
It's going to happen on Monday. No, I'm just joking. I have no idea.
Very specific. I like that bold call, but yes. Which Monday, we don't know. Not necessarily this Monday. It's going to happen on a Monday.
Yes, they'll do it over a weekend, but no, I'm joking. Look, trying to call the monetary reset is a fool's errand. I just know it's coming. I think the system wants to continue to kick the can down the road. So in this next coming recession, there'll be an attempt to reinflate everything with Fed and central bank money printing and fiscal deficit spending to help us out of the recession. And then we're going to go through what I call a very short-term temporary deflationary scare. You have to understand bankers can't abide by deflation because it ruins their balance sheets. So the credit cycle, obviously, boom and bust. It's designed to create a boom and bust cycle. Inflationary periods followed by deflationary periods when the debt goes bankrupt or can't be serviced anymore. We're at the beginning of a deflationary period, and then we're going to see a response. You'll see inflation. So my guess is they're going to try to kick the can down the road one more time. But if they can't, and we do have a serious systemic issue, maybe the monetary reset happens sooner rather than later. My guess is it doesn't happen until later. And gold is going to be a part of it because look, fiat debt-based currencies, everybody knows that they get debased over time. And if you're going to have a new monetary system that the globe agrees to transact on, gold has to be a part of it, or something, some part of it. And it's not. I think gold was kind of dismissed in 1971 when Nixon took us off the gold standard, and then we've had since then nothing but credit creation under the reserve currency known as the U.S. dollar. We're coming to the end of that, and so there has to be a new system, and there's no way that gold's not going to be part of it. I don't think.
Right. So let's bring it back to Fort Knox. Now, you have had some very contrarian positions that were contrarian at the time, but seem to now be gaining more and more credibility about certain occurrences in 2020, which I will not elaborate on. But let's talk about your thoughts on Fort Knox, because that has been a topic of a lot of, conspiracy. And the last audit of America's gold reserves was in 1953. And it sort of has become a topic that has re-entered the mainstream thanks to Elon Musk, who tweeted asking when the last time Fort Knox was audited. And he ignited a very real question, a very real debate. He posted on X, rather not tweeted, he posted on X, who is confirming that gold wasn't stolen from Fort Knox. Maybe it's there, maybe it's not. That gold is owned by the American public. We want to know if it's still there. And so kind of went on to then created this whole buzz about an audit and reignited a very real question. Now, why hasn't the US government opened the vaults for full verification? The US, by background, claims to hold over 8,000 tons of gold, mostly stored at Fort Knox, West Point, and the Denver Mint. And officially, the US has not added to its gold reserves since 1950. That's over 7 decades, with no official accumulation, despite, as you just mentioned, central banks around the world, especially China, buying aggressively. So not only have we not audited the gold, we officially have not added to it either, at least on record. Why? What do you think is going on there? Is the gold in Fort Knox? What is your theory, Ed Dowd?
Well, for decades, the gold bugs have been putting forth the theory that there's no gold at Fort Knox and it's gone. I have the exact opposite theory. I think we have more gold there than we know. And I just use common sense. And I've looked at what we've done over the last 20 years. We invaded Iraq. Their gold seemed to have disappeared. Same with Libya. So I think there's more gold in Fort Knox than we know. And that's why it's not being audited. I have the exact opposite position.
Because there's more gold, which may potentially be used in a potential monetary reset. Just by way of background, by the way, just to add some context to our viewers who may not know what you were referencing with Iraq and Libya, Gaddafi had amassed around 143 tons of gold physically held in Libya. He was working on launching a Pan-African gold-backed currency, the so-called gold dinar, as a way to push Africa off the dollar and the euro systems. Now, that, of course, would have been a direct threat to the petrodollar system. And after the NATO-backed intervention in 2011, that gold disappeared. Now, some of it may have been smuggled out, but a large portion has never been fully accounted for. You're saying it may have landed up in Fort Knox. To the victor go the spoils, I suppose. And the same goes for Saddam. By 2000, he started selling Iraqi oil in euros instead of dollars, another serious challenge to US dollar dominance. And after the invasion of Iraq, US forces secured Iraq's central bank. They recovered about 100 tons of gold. That gold was supposedly handed over to Iraqi authorities, but again, no public audit, no hard trail. So if you're right, and if some of that gold ended up in Fort Knox, it would mean that the US has quietly boosted its reserves without ever officially disclosing it, which would make the refusal to audit lend more credibility to why it's so suspicious that they don't want to audit it. So when do you think there will be a reveal? Like, at what point, if any, do you think it'll be necessary for the US to say, no, actually, we do have a lot more gold than we claim to. And there's a whole other theory that there's been shadow covert purchasing of gold, which we'll get into. But do you think that there will be some kind of moment where Fort Knox will be audited?
I suspect it. When there's a global monetary reset and gold is part of it, we'll audit and tell the truth. That would be the moment. But again, I don't know when that's going to happen. I think you made me aware of a quote from Trump about gold. What was the exact quote? He who has the gold. What was it
Makes the
again?
rules. Yeah. He who has
Makes
the
the
gold
rules.
makes the rules. The golden rule, he who has the gold makes the rules. Yeah.
Which would suggest to me he knows what's going on at Fort Knox.
Well, I want to put this out to you just to have you weigh in on this. Andy Schechtman, he has a striking theory. He believes that the U.S. is quietly preparing for this monetary reset, bringing gold back into the system to re-anchor confidence in the Treasury market, even if that means ultimately sacrificing the dollar. But he points to official trade data showing that just this year, just in 2025, the U.S. has imported 780 metric tons of gold. The U.S. has officially become a net importer of gold. And it's happening while the U.S. government officially claims that it hasn't added an ounce to its gold reserves since 1953. And Schechtman argues that it's a government-directed, off-the-books shadow program that, according to the Exchange Stabilization Fund, the president can authorize the Secretary of the Treasury, percent, to buy gold. Those transactions do need to be reported to Congress at some point. We do know that Scott Bessent is a big self-confessed gold bug as well. And Andy's theory is that this is happening covertly in the greater interest of the country. He also then points to the Gold Revaluation Act, and which allows the U.S. government to revalue its gold holdings. And he argues that this could be used at some point to backstop the collapsing demand for treasuries. We've seen, de-dollarization happening around the world. He thinks that the U.S. may be laying the foundation for a gold-linked adjustment to the monetary system, and not necessarily because it wants to, right, but because it has to, mirroring the BRICS strategies where countries like China, Russia, India are accumulating gold and potentially looking to launch a gold-linked currency, or currently, as China's doing, a gold-linked trade settlement mechanism, moving away from the dollar. So he reckons that gold linked to the system will need to happen to save the Treasury, and that this is happening behind the scenes. Hence, we're seeing the U.S. becoming a net importer of gold. And to your point, perhaps there's more gold in Fort Knox than we've been told. What do you make of that?
Well, there's two reasons likely why gold has been flowing into the U.S. Partly that covert buying. I tend to agree with that. But there's also another reason. Martin Armstrong has been saying that gold is moving to the U.S. out of Europe, primarily to prepare for war, which is not a very, nice thought to think of. But I think both things are happening. I guess today we just got an escalation with China and Trump. So, there's a lot of geopolitical risk out there that we need to pay attention to that can pop off at any time. We got Ukraine, Russia, we got Palestine, Gaza, and Israel and Iran, and we got Taiwan, China. We have Pakistan and India. There's a lot of geopolitical conflict, and if Europe is preparing for war, which they might have to do because of their pension system is a disaster, and those in power need an excuse to reset things. These are very interesting times, and gold and flows of capital are starting to indicate that there's something afoot in Europe, particularly.
But you're saying that Europe is sending gold into the U.S.?
That's what Martin Armstrong said.
In anticipation of war? Wouldn't they want their gold accessible?
If you think there's going to be a conventional war in Europe, you'd want your gold to be safely secured in a country like the U.S., as opposed to in your own vaults. This is obviously very theoretical, but
Correct.
You don't want the gold in your central bank if there's a problem.
Well, I mean, let's talk about the prospect of war. I believe you once said that war will be caused by those who seek to become the next world reserve currency or whatever system that follows. I mean, I've often maintained that I do not see the U.S. willingly giving up its status as the exorbitant privilege of being the global reserve currency. Trump has said that this is like a war. He says that the BRICS are trying to destroy the dollar.
BRICS was set up to degenerate our dollar and take our dollar as the standard, take it off as the standard. And that's okay if they want to play that game, but I can play that game too. So anybody that's in BRICS is getting a 10% charge. But what they're trying to do is destroy the dollar so that another country can take over and be the standard. And we're not going to lose the standard at any time. And if we lost the world standard dollar, that would be like losing a war, a major world war. We would not be the same country any longer. We're not going to let that happen. The dollar, you ever hear the expression, dollar is king? The dollar is king. We're going to keep it that way, okay?
But, you know, Trump has said that it's like losing a war, that it's not going to happen, not under his watch. You mentioned escalations. We're seeing that with Russia. President Trump says he's now moved 2 nuclear submarines after Russia's Medvedev has warned that things are escalating. Medvedev said that each new ultimatum that Trump makes towards Russia in pressuring an end to the conflict with Ukraine is a threat and a step towards war. That's coming out of Russia. Trump then goes and moves some submarines. How do you think this plays out? I mean, do you think that we could be on the brink of some kind of war with maintaining reserve currency status, the real agenda here?
That's hard to know. I'm not in the room. I'm not privy to a lot of these talks, but I watch what's happening. And global geopolitical conflict is a problem we need to watch. It's not something that you can predict. That's why we're hitching our tail to the housing crisis, which we think, like I said, is a white swan, very predictable, slow rolling problem that can't be avoided. But these things would only add to the uncertainty, and clearly war is not in anyone's interest. I can say this, the dollar reserve system is not going to go gently into the night. The whole military industrial complex benefits from our ability to create dollars out of thin air and force the countries of the world to transact in our dollars through the petrodollar, the SWIFT reserve system. We because of our position, are able to create money out of nothing, and the military-industrial complex feeds off that, and they will fight to the death to defend that, whether we want to or not.
Yeah, I'm not rooting for war, but I don't think that this is something that is going to happen without a major fight. One of the other fights that President Trump has taken on, of course, has been to try and rebalance trade and rebalance the U.S. manufacturing and onshore manufacturing and make the U.S. independent. And I want to get your thoughts on that and see what impact that may have long-term and short-term on the economy. As we know, the president is trying to rebalance the tariffs, which have been way off. He's also trying to onshore manufacturing, make the U.S. Independent, make America great again. And the goal is to rebuild American industry to protect national security, regain economic sovereignty. He's trying to repatriate supply chains, become more self-reliant, potentially preparing the country to weather future wars, future geopolitical or financial storms without relying on adversaries. You don't want to have China be responsible for your critical minerals if you're at war with China, right? So now, love him or hate him, it's a calculated bet. He's looking at short-term economic pain, volatility, for long-term sovereignty and strength, and ultimately, you could say for the greater good of the United States, for the greater longevity of the U.S., and he's willing to take the short-term hit for the bigger picture, for the sake of the country. But we have seen some success come his way. We've seen tariff revenues coming in, apparently coming into the tune of $150 billion so far. Scott Bessent, Treasury Secretary, says that could top $300 billion by the year end. We've had some big trade deals signed with countries pledging investment into the U.S., like the EU and Japan. So 2 questions here, Ed. Firstly, what impact do you see this having in the near term? Can Trump successfully balance some of these things off, reboost the economy with some of this tariff revenue and some of these billions of dollars? I think it's totaling about 2.8 trillion in terms of pledged investments into the U.S. Can that help the current economic picture short term? And is this the correct long-term strategy, even if it does mean some pain and volatility in the near term?
I agree it's the long-term correct strategy. It's the only choice we have to restore a middle class in the U.S. That's why we've had a rise of national populism across not only the U.S., but in Europe as well. So it's long-term a great strategy, but unfortunately there is short-term pain that can't be avoided. Tariffs, we have tariffs without a rebalance. So the tariffs are the initial foray. They're deflationary. They'll cause inflation to maybe boost up a little bit, but long-term they're deflationary. And all these trade deals, mind you, the EU and Japan that just got announced, they need to be ratified by their respective parliaments. That'll take time. So they're not legal binding agreements, they're frameworks. And all the dollars of investment pledged don't need to start moving until they're legally binding. So that's what we call a valley before the going up the mountain on the other side. So we're going to experience a valley. That this pledged construction isn't going to start hitting for a while, and when it does start, it takes time to let's use Toyota automobile plant. You need to find a site, get the permits, break ground, construct the plant, then hire. So there's a time delay. There's a valley in between. But long term, I definitely agree it's the right strategy. But to claim that these investment dollars are going to hit the ground running right now and save us, not going to happen.
Not going to happen. So as we wrap up here, Ed, your highest point of conviction at the moment?
This is the biggest asymmetric trade I've ever seen in my life. And what I mean by that is we've had an economic variable, an elephant in the room that a lot of people just missed. We've had fraudulent non-farm payroll numbers or statistical incompetence. The Fed holding rates too high, and I think I think we're going to see a reallocation out of equities into fixed income, and it's going to be probably happen faster rather than slower. And I think it's one of the biggest asymmetric trades I've seen in my lifetime, because consensus is you don't want to be in bonds, and the economy's fine, and Trump's going to save us, and equities are great. And I think everybody's on the wrong side of this trade, and it's only a matter of time until the herd starts to move.
And I know you said that you're seeking shelter in T-bills and in gold right now. What about Bitcoin? How do you see Bitcoin fitting into this picture in this near-term recession that we're talking about, and also in this longer-term potential monetary reset that we're talking about?
Well, Bitcoin is 95% correlated to the NASDAQ. If you look at its price today, it's down in sympathy with the NASDAQ. Bitcoin is a risk-on asset. No matter the merits or what you think of it, it is literally a risk-on asset. So in a risk-off environment, which we're predicting, it'll go down. Now, there's a lot of people who are believers in Bitcoin thinking that it's going to decouple from this historical relationship at some point. But until it does, I'm a math guy, and Bitcoin is going to participate in the risk-off trade and depreciate substantially, in my humble opinion. That doesn't mean I hate Bitcoin. I'm not for Bitcoin. It just means you can pick it up lower and cheaper.
All right. So the move you're saying, not giving financial advice, but to rebalance going into fixed income.
Well, if you're really risk averse, just go into T-bills. If you're more of a speculator and have a capital to play with, 30-year bonds and 10-year bonds, because those will appreciate substantially in price as the Federal Reserve embarks on an interest rate cut, and the U.S. economy, along with the globe, sees slowing growth. Long bonds love slower growth. They love deflation. They don't like inflation, as we just found out the last 4 years. So if we're right, and we're going to have a deflationary scare, long bonds are going to see nice appreciation.
Right. Although ultimately, what the real value of those bonds with the value of the dollar and the big picture is yet to be determined. Ed, where can people learn more about your work? Where can people find you?
We're at financetechnologies.com, spelled with a PH. We have a product store where we sell our big report, and we have a bunch of follow-on reports, mostly on real estate at the moment. We're going to be issuing a package next week that has 3 real estate reports for a nice price. You can also follow me on X at Dowd Edward, D-O-W-D Edward, where I put out like our real-time thoughts and our most recent reports. We also have a lot of free resources on our website. We put out a lot of free research. Our analysis of Trump's tariffs are there. Our analysis of the stock bubble is there. Lots of other things. That's under free resources.
All right. Well, thank you for sharing some of your resources freely with us. Really appreciate your insight. Really appreciate you putting yourself out there. Global monetary reset happening on Monday. I'm kidding. I know that was a joke. No, I know that was a joke. But I really do appreciate you having so much conviction and meticulously well-researched data points. It's always a pleasure chatting with you, Ed, and I look forward to having you back on. Thank you so much.
Thank you, Michelle. Great to be here.
And thank you for watching The Real Story, where we give you the real facts, the real risks, the real shift, and the real opportunities. And we really do appreciate your viewership and your support, so please make sure to subscribe and leave us your feedback. We love hearing from you. For me, Michelle Makori, and the rest of the team, see you soon.